Hello, my name's Dave Emory, and this is For the Record program number 740, Update on the Meltdown, Part 6, the Wachovia File. This program is being recorded on April 23rd of the year 2011. This program is going to be focusing on the relationship between the illicit drug trade, in turn, elements of the illicit drug trade that appear to overlap the intelligence community, and the financial institutions, some of which went belly up in the last decade, many of which are shaky and figure to go belly up in the not-too-distant future, many of which have been and others of which will be bailed out by, you and me, folks, the taxpayer, Mr. and Mrs. America, and not all the ships at sea, certainly not GE, and not an awful lot of rich folks, not past a point anyway, a lot of other corporations. But we're going to be taking a look at the relationship between the financial industry and the drug trade, and in the background, the intelligence community. A few things to note here. First of all, we're going to be talking about Wachovia. Large financial institution. It was involved in laundering money for Mexican cartels. This story came out, and ultimately it turned out that the volume of laundering, the volume of money laundered for the cartels was much larger than what the public had been told. There was just a tiny wrist slap given in connection with this. Ultimately, Wachovia went belly up, not before receiving a great deal of assistance from the Federal Reserve. More about that in For the Record 741. Interestingly, it appears to have gone belly up and began sucking money from the Federal Reserve right after the interdiction of the money from the Mexican cartel. So note, first of all, that the operation we're talking about goes through Wachovia, one of this country's larger financial institutions in its day. It went belly up, and the operations are inextricably linked with the operations that were behind a DC-9 jet that was in the Mexican city of Ciudad del Carmen. It was arrested it was waylaid, detained by Mexican authorities with 5.7 tons of cocaine, with a street value of $100 million. This was in April of 06. This is the DC-9 bust that Daniel Hopsicker has talked about. And that, in turn, is inextricably linked with the milieu of Huffman Aviation, of the Venice Flying Circus, as Daniel called it, basically the organized crime / intelligence / drug smuggling milieu through which Mohammed Atta and some of the other hijackers infiltrated. Note also that an investigator who was sorting through the ill-doing of Wachovia's dealings with the Mexican cartels was actively frustrated in his investigation by Wachovia. And again, note that in July of 2007, whether it was because of this investigation and or because of other factors, the money began drying up. The flow of money to Wachovia from the Mexican drug cartels began drying up. And as we'll see in For the Record 741, this is right as the cash flows were drying up for many of the institutions that went belly up following the bursting of the real estate bubble. We're going to be relying for our information on a very good article from the Guardian newspaper, the British Guardian, of April 3rd of 2011. This article is titled, How a Big U.S. Bank Laundered Billions from Mexico's Murderous Drug Gangs. It's subtitled, As the Violence Spread, Billions of Dollars of Cartel Cash Began to Seep into the Global Financial System. But a special investigation by the Observer reveals how the increasingly frantic warnings of one London whistleblower were ignored. The article reads in part, now again note the DC-9 bust here. This is the bust that Daniel Hopsicker has talked about, connected to the milieu he's been investigating in South Florida. On April 10, 2006, a DC-9 jet landed in the port city of Ciudad del Carmen on the Gulf of Mexico as the sun was setting. Mexican soldiers waiting to intercept it found 128 cases packed with 5.7 tons of cocaine, with a street value estimated at $100 million. But something else, more important and more far-reaching, was discovered in the paper trail behind the purchase of the plane behind the Sinaloa narco-trafficking cartel. During a 22-month investigation by agents from the U.S. Drug Enforcement Administration, the Internal Revenue Service, and others, it emerged that the cocaine smugglers had bought the plane with money that they had laundered through one of the biggest banks in the United States, Wachovia, now part of the giant Wells Fargo. The authorities uncovered billions of dollars in wire transfers, travelers' checks, and cash shipments through Mexican exchanges into Wachovia accounts. Wachovia was put under immediate investigation for failing to maintain an effective anti-money laundering program. Of special significance was that the period concerned began in 2004. Repeating. Of special significance was that the period concerned began in 2004, which coincided with the first escalation of violence along the U.S.-Mexico border that ignited the current drugs war. That's when this particular concatenation gained momentum. We're going to see when it began losing momentum. Criminal proceedings were brought against Wachovia, though not against any individual, but the case never came to court. In March of 2010, Wachovia settled the biggest action brought under the U.S. Bank Secrecy Act through the U.S. District Court in Miami. Now that the year's deferred prosecution has expired, the bank is in effect in the clear. It paid federal authorities $110 million in forfeiture for allowing transactions later proved to be connected to drug smuggling, and incurred a $50 million fine for failing to monitor cash used to ship 22 tons of cocaine. More shocking and more important, the bank was sanctioned for failing to apply the proper anti-laundering strictures to the transfer of $378.4 billion, a sum equivalent to one-third of Mexico's gross national product, into dollar accounts from so-called casas de cambio, or CDCs in Mexico, currency exchange houses with which the bank did business. This last paragraph again. More shocking and more important, the bank was sanctioned for failing to apply the proper anti-laundering strictures to the transfer of $378.4 billion, a sum equivalent to one-third of Mexico's gross national product, into dollar accounts from so-called casas de cambio, or CDCs in Mexico, currency exchange houses with which the bank did business. So the sum that they were laundering, $378.4 billion, they got fined $160 million, and it was roughly a third of the gross national product of Mexico that they were laundering here. So naturally, when this particular conduit dried up, well, Wachovia was going down. Continuing with this Guardian article from, of course, the London Observer. Wachovia's blatant disregard for our banking laws gave international cocaine cartels a virtual carte blanche to finance their operations, unquote, said Jeffrey Sloman, the federal prosecutor. Yet the total fine was less than 2% of the bank's $12.3 billion profit for 2009. On March 24th of 2010, Wells Fargo stock traded at $30.86, up 1% on the week of the court settlement. The conclusion of the case was only the tip of an iceberg, demonstrating the role of the legal, unquote, banking sector in swilling hundreds of billions of dollars, the blood money from the murderous drug trade in Mexico and other places in the world around their global operations, now bailed out by the taxpayer. And, of course, interrupting briefly, although it's not discussed past a point here, looming in the background of all of this, elements of the intelligence community. Continuing, at the height of the 2008 banking crisis, Antonio Maria Costa, then head of the United Nations Office on Drugs and Crime, said he had evidence to suggest the proceeds from drugs and crime were, quote, the only liquid investment capital, unquote, available to banks on the brink of collapse. Quote, interbank loans were funded by money that originated from the drugs trade, he said, again quoting, there were signs that some banks were rescued that way, unquote. Wachovia was acquired by Wells Fargo during the 2008 crash, just as Wells Fargo became a beneficiary of $25 billion in taxpayers' money. Wachovia's prosecutors were clear, however, that there was no suggestion Wells Fargo had behaved improperly. It had cooperated fully with the investigation. Mexico is the U.S.'s third-largest international trading partner, and Wachovia was understandably interested in this volume of legitimate trade. José Luis Marmoleo, who prosecuted those running one of the casas de cambio at the Mexican end, said, quote, Wachovia handled all the transfers. They never reported any as suspicious. That's $378.4 billion in transfers, folks. That's a lot of money. As early as, again quoting, as early as 2004, Wachovia understood the risk. Quote, the bank admitted in the statement of settlement with the federal government, but, quote, despite these warnings, Wachovia remained in the business, unquote. There is, of course, the legitimate use of CDCs as a way into the Hispanic market. In 2005, the World Bank said that Mexico was receiving $8.1 billion in remittances. During research into the Wachovia Mexican case, the Observer obtained documents previously provided to financial regulators. It emerged that the alarm that was ignored came from, among other places, London, as a result of the diligence of one of the most important whistleblowers of our time. A man who, in a series of interviews with the Observer, adds detail to the documents, laying bare the story of how Wachovia was at the center of one of the world's biggest money laundering operations. Martin Woods, a Liverpudlian in his mid-40s, joined the London office of Wachovia Bank in February of 2005 as a senior anti-money laundering officer. He had previously served with the Metropolitan Police Drug Squad. As a detective, he joined the money laundering investigation team of the National Crime Squad, where he worked on the British end of the Bank of New York money laundering scandal in the late 1990s. Woods talks like a police officer in the best sense of the word. Punctilious, exact, with a roguish sense of humor but moral at the core. He was an ideal appointment for any bank eager to operate a diligent and effective risk management policy against the lucrative scourge of high finance, laundering, knowing or otherwise, the vast proceeds of criminality, tax evasion, and dealing in arms and drugs. Woods had a police officer's eye and a police officer's instincts, not those of a banker. And this influenced not only his methods, but his mentality. Quote, I think that a lot of things matter more than money, and that marks you out in a culture which appears to prevail in many of the banks in the world, he says. Woods was set apart by his modus operandi. His specialty, he explains, was his application of a Know Your Client or KYC policing strategy to identify dirty money. KYC is a fundamental approach to anti-money laundering, going after tax evasion or counter-terrorist financing. Who are your clients is the documentation right. Good, responsible banking involved always knowing your customer, and it still does, unquote. When he looked at Wachovia, the first thing Woods noticed was a deficiency in KYC information. And among his first reports to his superiors at the bank's headquarters in Charlotte, North Carolina, were observations on a shortfall in KYC at Wachovia's operation in London, which he set about correcting, while at the same time implementing what was known as an enhanced transaction monitoring program, gathering more information on clients whose money came through the bank's offices in the city in sterling or euros. By August of 2006, Woods had identified a number of suspicious transactions relating to Casas de Cambio customers in Mexico. Primarily, these involved deposits of travelers' checks in euros. They had sequential numbers and deposited larger amounts of money than any innocent traveling person would need, with inadequate or no KYC information on them, and what seemed to a trained eye to be dubious signatures. It was basic work, Wood says. They didn't answer the obvious questions. Is the transaction real or does it look synthetic? Does the traveler's check meet the protocols? Is it all there, and if not, why not? Unquote. Woods discussed the matter with Wachovia's global head of anti-money laundering for correspondent banking, who believed the checks could signify tax evasion. He then undertook what banks call a look-back, unquote, at previous transactions, and saw fit to submit a series of SARs or suspicious activity reports to the authorities in the UK and his superiors in Charlotte, urging the blocking of named parties and large series of sequentially numbered travelers' checks from Mexico. He issued a number of SARs in 2006, of which 50 related to the Casas de Cambio in Mexico. To his amazement, the response from Wachovia's Miami office, the center for Latin American business, was anything but supportive. He felt it was quite the reverse. As it turned out, however, Woods was on the right track. Wachovia's business in Mexico was coming under closer and closer scrutiny by U.S. federal law enforcement. Wachovia was issued with a number of subpoenas for information on its Mexican operation. Woods has subsequently been informed that Wachovia had 6,000 or 7,000 subpoenas. He says this was, quote, an absurd number. So at what point does someone at the highest level not get the feeling that something is very, very wrong, unquote? In April and May of 2007, Wachovia, as a result of increasing interest and pressure from the U.S. Attorney's Office, began to close its relationship with some of the Casas de Cambio. But rather than launch an internal investigation into Woods' alerts over Mexico, Woods claims Wachovia hung its own money laundering expert out to dry. The records show that during 2007, Woods, quote, continued to submit more SARs related to the Casas de Cambio, unquote. Now, note the following. In July of 2007, all of Wachovia's remaining 10 Mexican Casa de Cambio's clients operating through London suddenly stopped doing so. Later in 2007, after the investigation of Wachovia was reported in the U.S. financial media, the bank decided to end its remaining relationships with the Mexican Casas de Cambio globally. By this time, Woods says, he found his personal situation within the bank untenable, while the bank acted on one level to protect itself from the federal investigation into its shortcomings. On another, it rounded on the man who had been among the first to spot them. On June 16, 2007, Woods was told by Wachovia's head of compliance that his latest SAR need not have been filed, that he had no legal requirement to investigate an overseas case, and no right of access to documents held overseas from Britain, even if they were held by Wachovia. Woods' life went into freefall. He went to the hospital with a prolapsed disc, reported sick, and was told by the bank that he had not done so in the appropriate manner as directed in the employee's handbook. He was off work for 3 weeks, returning in August of 2007 to find a letter from the bank's compliance managing director which was unrelenting in its tone and words of warning. The letter addressed itself to what the manager called, quote, specific examples of your failure to perform at an acceptable standard, unquote. Woods, at this point on the edge of a breakdown, was put on sick leave by his GP. He was later given psychiatric treatment, enrolled on a stress management course, and put on medication. Late in 2007, Woods attended a function at Scotland Yard where colleagues from the U.S. were being entertained. There, he sought out a representative of the Drug Enforcement Administration and told him about the Casas de Cambio, the SARs, and his employer's reaction to them. The Federal Reserve and officials of the Office of Comptroller of Currency in Washington, D.C. then, quote, spent a lot of time examining the SARs, unquote, that had been sent by Woods to Charlotte from London. They got back in touch with me a while afterwards, and we began to put the pieces of the jigsaw puzzle together, says Woods. What they found was, as Costa says, the tip of the iceberg of what was happening to drug money in the banking industry, but at least it was visible, and it had a name, Wachovia. In July of 2005, the DEA, the Criminal Division of the Internal Revenue Service, and the U.S. Attorney's Office in southern Florida began investigating wire transfers from Mexico to the U.S. They were traced back to correspondent bank accounts held by Casas de Cambio at Wachovia. The CDC accounts were supervised and managed by a business unit of Wachovia in the bank's Miami offices. Through CDCs, said the court document, persons in Mexico can use hard currency and wire transfer the value of that currency to U.S. bank accounts to purchase items in the United States or other countries. The nature of the CDC business allows money launderers the opportunity to move drug dollars that are in Mexico into CDCs and ultimately into the U.S. banking system. On numerous occasions, unquote, say the court papers again quoting, monies were deposited into a CDC by a drug trafficking organization. Using false identities, the CDC then wired that money through its Wachovia correspondent bank accounts for the purchase of airplanes for drug trafficking organizations, unquote. The court settlement of 2010 would detail that, quote, nearly $13 million went through correspondent bank accounts at Wachovia for the purchase of aircraft to be used in the illegal narcotics trade. From these aircraft, more than 20,000 kilograms of cocaine were seized, unquote. All this occurred despite the fact that Wachovia's office was in Miami, designated by the U.S. government as a high-intensity money laundering and related financial crime area, unquote, and a, quote, high-intensity drug trafficking area. Since the drug cartel war began in 2005, Mexico had been designated a high-risk source of money laundering. As early as 2004, the court settlement would read, again quoting, Wachovia understood the risk that was associated with doing business with the Mexican CDTCs. Wachovia was aware of the general industry warnings. As early as July of 2005, Wachovia was aware that other large U.S. banks were exiting the CDC business based on anti-money laundering concerns. Despite these warnings, Wachovia remained in business, unquote. On March 16, 2010, Douglas Edwards, senior vice president of Wachovia Bank, put his signature to page 10 of a 25-page settlement in which the bank admitted its role as outlined by the prosecutors. On page 11, he signed again as senior vice president of Wells Fargo. The documents show Wachovia providing 3 services to 22 CDCs in Mexico, wire transfers, a bulk cash service, unquote, and a pouch deposit service, unquote, to accept deposit items drawn on U.S. banks, e.g. checks and traveler's checks, unquote, as spotted to Woods. How do you like those services? Excuse me interrupting, obviously. When you go to the bank, do they offer you a pouch deposit service? How about a bulk cash service? I mean, I've no doubt that such things are there, but gosh, a pouch deposit service. You deposit this pouch for me, all right? I mean, I can't imagine anything like that would ever get involved in illicit money transferring. Can you? No. Anyway, continuing. Quote, for the time period of May 1st, 2004 through May 31st of 2007, Wachovia processed at least $373.6 billion in CDCs, $4.7 billion in bulk cash, a total of more than $378.3 billion, a sum that dwarfs the budgets debated by the U.S. state and U.K. local authorities to provide services to citizens. The document gives a fascinating insight into how the laundering of drug money works. It details how investigators, quote, found readily identifiable evidence of red flags of large-scale money laundering, unquote. There were structured wire transfers, unquote, whereby it was commonplace in the CDC accounts for round-number wire transfers to be made on the same day or in close succession by the same wire senders for the same account. Over 2 days, 10 wire transfers by 4 individuals, quote, went through Wachovia for deposit into an aircraft broker's account. All of the transfers were in round numbers. None of the individuals of business that wired money had any connection or to the aircraft or the entity that allegedly owned the aircraft. The investigation has further revealed that the identities of the individuals who sent the money were false and that the business itself was a shell entity. The plane was subsequently seized with approximately 2,000 kilograms of cocaine on board, unquote. Many of the sequentially numbered traveler's checks of the kind dealt with by Woods contained unusual markings or lacked any legible signature, unquote. Also, many of the CDCs that used Wachovia's bulk cash service sent significantly more cash to Wachovia than what Wachovia had expected. More specifically, many of the CDCs exceeded their monthly activity by at least 50%. Recognizing these red flags, the U.S. Attorney's Office in Miami, the IRS, and the DEA began investigating Wachovia, later joined by FinCEN, one of the U.S. Treasury's agencies to fight money laundering, while the Office of the Comptroller of the Currency carried out a parallel investigation. The violations they found were, says the document, serious and systemic, and allowed certain Wachovia customers to launder millions of dollars of proceeds from the sale of illegal narcotics through Wachovia accounts over an extended time period. The investigation has identified that at least $110 million in drug proceeds were funneled through the CDC accounts held at Wachovia, unquote. The settlement concludes by discussing Wachovia's considerable cooperation in remedial actions, unquote, since the prosecution was initiated after the bank was bought by Wells Fargo. In consideration of Wachovia's remedial actions, unquote, concludes the prosecutor, the United States shall recommend to the court that prosecution of Wachovia on the information filed be deferred for a period of 12 months, unquote. But while the federal prosecution proceeded, Woods had remained out in the cold. On Christmas Eve 2008, his lawyers filed tribunal proceedings against Wachovia for bullying and detrimental treatment of a whistleblower. The case was settled in May of 2009, by which time Woods felt as though he was, quote, the most toxic person in the bank, unquote. Wachovia agreed to pay an undisclosed amount in return for which Woods left the bank and said he would not make public the terms of the settlement. After years of tribulation, Woods was finally formally vindicated, though not by Wachovia. A letter arrived from John Dugan, the controller of the currency in Washington, D.C., dated March 19, 2010, 3 days after the settlement in Miami. Dugan said he was writing to personally recognize and express my appreciation for the role you played in the actions brought against Wachovia Bank for violations of the Bank Secrecy Act. Not only did the information that you provided facilitate our investigation, but you demonstrated great personal courage and integrity by speaking up. Without the efforts of individuals like you, actions such as the one taken against Wachovia would not be possible, unquote. The so-called deferred prosecution, unquote, detailed in the Miami document is a form of probation whereby if the bank abides by the law for a year, charges are dropped. So this March, the bank was in the clear. The week that the deferred prosecution expired, a spokeswoman for Wells Fargo said the parent bank had no comment to make on the documentation pertaining to Woods' case or his allegations. She added that there was no comment on Sloman's remarks to the court. A provision in the settlement stipulated Wachovia was not allowed to issue public statements that contradicted it. But the settlement leaves a sour taste in many mouths, and certainly in Woods's. The deferred prosecution is part of this cop-out all round, he says. The regulatory authorities do not have to spend any more time on it, and they don't have to push it as far as a criminal trial. They just issue criminal proceedings and settle. The law enforcement people do what they're supposed to do, but what's the point? All these people dealing with all that money from drug trafficking and murder, and no one goes to jail, unquote. One of the foremost figures in the training of anti-money laundering officers is Robert Mazur, lead infiltrator for U.S. law enforcement of the Colombian Medellin cartel during the epic prosecution and collapse of the BCCI banking business in 1991. Mazur, whose firm Chase & Associates works closely with law enforcement agencies and trains officers for bank anti-money laundering, cast a keen eye over the case against Wachovia. And he says that, quote, the only thing that will make the banks properly vigilant to what is happening is when they hear the rattle of handcuffs in the boardroom, unquote. Mazur said that, again quoting, a lot of the law enforcement people were disappointed to see a settlement between the administration and Wachovia. But I know there were external circumstances that worked to Wachovia's benefit, not least that the U.S. banking system was on the edge of collapse, unquote. What concerns Mazur is that what law enforcement agencies and politicians hope to achieve against the cartels is limited and falls short of the obvious attack the U.S. could make in its war on drugs, go after the money. We're thinking way too small, Mazur says. I train law enforcement officers, thousands of them every year, and they say to me that if they tried to do half of what I did, they'd be arrested. But I tell them, you got to think big. The headlines you will be reading in 7 years' time will be the result of work you begin now. With BCCI, we had to spend 2 years setting it up, 2 years doing undercover work, and another 2 years getting it to trial. If they want to do something big, like go after the money, that's how long it takes. But, Mazur warns, if you look at the career ladders of law enforcement, there's no incentive to go after the big money. People move every 2 to 3 years. The DEA is focused on drug trafficking rather than money laundering. You get a quicker result that way. They want to get the traffickers and seize their assets, but this is like treating a sick plant by cutting off a few branches. It just grows new ones. Going after the big money is cutting down the plant. It's a harder door to knock on, it's a longer haul, and it won't get you the short-term riches. And that concludes the look into the Wachovia file. And this is for the record program number 741, Update on the Meltdown, Part 7, Bail, Bail, the Gang's All Here. This program is being recorded on April 23rd of the year 2011. We're going to plunge right in where we, in a sense, left off in, for the record, 740. We were talking about Wachovia and its laundering of vast amounts of money for Mexican drug cartels, a sum equal to roughly a third of the gross national product of Mexico. That, in turn, was inextricably linked with the operations that Daniel Hopsicker has been chronicling for us on and off for a number of years. In the article, it's actually a London Observer article that was run by The Guardian. It's called How a Big U.S. Bank Laundered Billions from Mexico's Murderous Drug Gangs, and it contains a quote here from Antonio Maria Costa, who was executive director of the UN's Office on Drugs and Crime. And he said, he's quoted here, "The connection between organized crime and financial institutions started in the late 1970s and early 1980s when the mafia became globalized," unquote. Then two things happened. He is skipping down. The financial crisis in Russia after the emergence of the Russian mafia and the crises of 2003 and 2007 and 8. With these crises, says Costa, the banking sector was short of liquidity. The banks exposed themselves to the criminal syndicates who had cash in hand. And then talking about this, Mr. Woods, the Wachovia London branch investigator who helped to uncover this wrongdoing and who was basically leaned on in no uncertain terms by Wachovia, went on to describe the effects of this. New York and London, says Woods, have become the world's two biggest laundries of criminal and drug money and offshore tax havens. Not the Cayman Islands, not the Isle of Man or Jersey. The big laundering is right through the city of London and Wall Street. After the Wachovia case, no one in the regulatory committee has sat down with me and asked, what happened or what can we do to avoid this happening to other banks? They're not interested. They're the same people who attack the whistleblowers, and this is a position the British Financial Services Authority at least has adopted on legal advice. It has been advised that the confidentiality of banking and bankers takes primacy over the Public Information Disclosure Act. That is how the priorities work: secrecy first, public interest second. Meanwhile, the drug industry has two products: money and suffering. And remember that it was in July of 2007, when these investigations were going on, that the funny money from the Mexican CDCs, the Casas de Cambio, began to dry up. And a lot of other things were drying up, too, including short-term lending to a number of the troubled financial institutions. Recently, there was a disclosure of documents by the Federal Reserve Bank, and it disclosed a number of interesting things. Now, we're going to be taking a look once again at Wachovia. In a sense, we're kind of going to dolly out with the camera, and we're not only going to take a look at Wachovia, but we're going to be taking a look at what was happening with Wall Street and the Federal Reserve right in the period of time when Wachovia was getting ready to go belly up and they were losing the access to the Mexican drug capital. That was in July and August of 2007. A New York Times article of April 3rd of 2011 by Gretchen Morgensen, actually April 2nd of 2011 by Gretchen Morgensen, called "The Bank Run We Knew So Little About," and it reads, in August of 2007, as world financial markets were seizing up, domestic and foreign banks began lining up for cash from the Federal Reserve Bank of New York. That August 20th, Commerzbank of Germany borrowed $350 million at the Fed's discount window. 2 days later, Citigroup, J.P. Morgan Chase, Bank of America, and the Wachovia Corporation each received $500 million. As collateral for all these loans, the bank put up a total of $213 billion in asset-backed securities, commercial loans, and residential mortgages, including second liens. Thus began the bank run that set off the financial crisis of 2008, but unlike other bank runs, this one was invisible to most Americans. Until last week, that is, when the Fed pulled back the curtain. Responding to a court ruling, it made public thousands of pages of confidential lending documents from the crisis. The data dump arose from a lawsuit initiated by Mark Pittman, a reporter at Bloomberg News, who died in November of 2009. Don't know anything about the man's death, but listen to this. The data dump, right, this huge disclosure, and it really is a monumental disclosure. The data dump arose from a lawsuit initiated by Mark Pittman, a reporter at Bloomberg News who died into November of 2009. Upon receiving his request for details on the central bank's lending, the Fed argued that the public had no right to know. The courts disagreed. The Fed documents, like much of the information about the crisis that has been pried out of reluctant government agencies, reveal what was going on behind the scenes as the financial storm gathered. For instance, they show how dire the banking crisis was becoming during the summer of 2007. Washington policymakers, meanwhile, were saying that the subprime crisis would reside with little impact on the broad economy and that world markets were highly liquid. For example, on July 23, 2007, Henry M. Paulson, Jr., the Treasury Secretary at the time, said the housing slump appeared to be, quote, at or near the bottom, unquote. 2 days later, Timothy F. Geithner, then the president of the New York Fed, declared in a speech before the Forum on Global Leadership in Washington, unquote, financial markets outside the United States are now deeper and more liquid than they used to be, making it easier for companies to raise capital domestically at a reasonable cost, unquote. Within about a month's time, however, foreign banks began thronging to the Fed's discount window, its mechanism for short-term lending to banks. Over 4 days in late August and early September, foreign institutions through their New York branches received a total of almost $1.7 billion in Fed loans. As the global run progressed, banks increased their borrowings, the documents show. For example, on September 12, 2007, Citibank drove up to the New York Fed's window. It extracted $3.375 billion of cash in exchange for $23 billion worth of assets, including commercial mortgage-backed securities, residential mortgages, and commercial loans. That transaction seemed to get the Fed's attention. At 1:30 that afternoon, Mr. Geithner spent half an hour on the phone with Gary L. Crittenden, Citi's chief financial officer at the time, Mr. Geithner's calendar shows. A few weeks later, Citigroup announced that it was writing off $5.9 billion in the third quarter, causing its profit to drop 60% from a year earlier, and that was only the beginning. Perhaps the biggest revelation in the Fed documents is the extent to which the central bank was willing to lend to foreign institutions. On November 8, 2007, Deutsche Bank took out $2.4 billion in a $2.4 billion overnight loan secured by $4 billion in collateral. And on December 5, 2007, Callion of France borrowed $2 billion, providing $16 billion in collateral. When the crisis was full on in 2008, foreign institutions became even bigger beneficiaries of the Fed's credit programs. On November 4th of that year, the Fed extended $133 billion through various facilities. Now, note these next two institutions, because we're going to come back to these in a second. Two foreign institutions, the German-Irish bank DEPFA, D-E-P-F-A, and Dexia Credit of Belgium, received 39% of the money on that day being November 4th of 2008. Keep an eye on these two institutions. We're going to come back to them. DEPFA, the German-Irish Bank, and Dexia Credit of Belgium, part of the Baron Lambert of Drexel Burnham Lambert fame in Luxembourg, and we're going to talk more about that in a second. The striking thing was the large amount of borrowing that the New York Fed accepted during the crisis from European banks that had only a minimal presence in the United States and arguably posed no threat to the U.S. payment system, said Walker F. Todd, a research fellow at the American Institute for Economic Research and a former assistant general counsel and research officer at the Federal Reserve Bank of Cleveland. Such a thing would never have occurred 20 years ago, he added. All of the discount window borrowings extended to institutions during the debacle have been repaid, but the precedent was set. The Fed was the financial backstop to the world. Since 2000 or so, the mindset of the Fed in New York and Washington has been that the central bank must step in when there is a global crisis. Mr. Todd said that even if it appears to extend its mandate. Ben S. Bernanke, the Fed chairman, seemed to foreshadow this view early in the crisis. Addressing the Fed's annual symposium at Jackson Hole, Wyoming on August 17, 2007, Mr. Bernanke said, "It is not the responsibility of the Federal Reserve, nor would it be appropriate to protect lenders and investors from the consequences of their financial decisions. But developments in financial markets can have broad economic effects felt by many outside of the market," said the Federal Reserve, which must take those effects into account when determining policy. Protecting global lenders and investors from the effects of their financial decisions was exactly what the Fed decided it had to do. Bankers and investors on the receiving end of this largesse have long known the extent to which the Fed rescued them in their time of need. Now, thanks to these Fed documents, the rest of us can see it too. Now again, note those two institutions I highlighted. Dexia, that's a Luxembourg-based company. It's part of the Baron Lambert complex in Luxembourg. Luxembourg, by the way, a long-standing money laundering center. It also is inextricably linked with the Bormann Capital Network, about which I've spoken so often. In the book, Martin Bormann, Nazi in Exile by Paul Manning, available for download for free on the SpitfireList.com website. There's a long section about Luxembourg. You can also read that in For the Record 305, an excerpting of the text. Those two banks, Dexia, part of the Lambert Banque Internationale de Luxembourg, and also the DEPFA Group, DEPFA, that is a German-Irish bank and one of the Landesbanks, as they're called. Now, those were two of the institutions that received a lot of the Fed's borrowing, and as we're going to see, what that basically did was to bail them out, and in so doing, saving U.S. municipal bonds and perhaps state debt as well, apparently state debt as well, because those two banks had basically been engaged in what appears to have been some illegal financial machinations vis-a-vis that municipal and perhaps state debt. So it was basically what Dexia and DEPFA were apparently doing was engaging in criminal activity, which helped to bankrupt them, so then we bail them out, or courtesy the Federal Reserve bails them out. It now turns out that the loophole that was used to bail out these foreign banks, or not so much a loophole, but the provision which was utilized to bail out these banks by extending them loans, has basically been on the books for a long, long time. We, however, did not know about it. This is an article from Bloomberg News by Bob Ivry, IVRY, April 5th, 2011. Fed's biggest foreign bank bailout saved U.S. muni bonds. A European bank that received the most Federal Reserve discount window help during the financial crisis also took $381 billion in aid from its home countries and owned subsidiaries implicated in bid rigging that prosecutors say defrauded U.S. taxpayers. Details of Fed lending released last week show that Dexia SA, or DEXB, based in Brussels and Paris, borrowed as much as $37 billion, with an average daily loan amount of $12.3 billion in the 18 months after Lehman Brothers Holdings Incorporated collapsed in September of 2008. The House subcommittee that oversees the Fed plans hearings on the central bank's discount window lending to offshore financial institutions next month. By lending to Dexia, again, that's the Luxembourg bank, the Fed kept money flowing into local government projects throughout the U.S., as well as the money market funds that invested in them. Dexia guaranteed bonds issued by entities as varied as the Texas State Veterans Land Board in Austin and the Los Angeles County Metropolitan Transportation Authority. Quote, if Dexia went bankrupt, it could have been a catastrophe for municipal finance and money funds, said Matt Fabian, a Concord, Massachusetts-based senior analyst and managing director at Municipal Markets Advisors, an independent research company. Again, quoting, the market has extensive exposure to foreign banks, unquote. Note that for future reference. Overseas banks accounted for 70% of discount window loans when borrowing reached its peak of $113.7 billion in October of 2008, according to the Fed's data. The discount window established in 1914 is known as the lender of last resort. By law, most U.S. branches of foreign banks have access to the discount window, said David Skidmore, a spokesman for the American Central Bank. They are important providers of credit to U.S. businesses and households, and discount window lending during the financial crisis helped support their continued lending in the United States, he said. The Fed has kept discount window borrowers secret for 97 years. Last week's disclosures were court-mandated after legal victories by Bloomberg LP, the parent of Bloomberg News, and News Corp's Fox News Network, LLC. DEPFA Bank PLC, a German-owned bank based in Dublin, Ireland, was another insurer of municipal bonds in the U.S. DEPFA's discount window borrowing peaked at $28.5 billion in November of 2008. Dexia, which borrowed $37 billion from the discount window in January of 2009, said its loans from the European Central Bank peaked at 122 billion euros, or $173 billion in October of 2008. That month, it also received about $200 billion in debt guarantees and $8 billion in cash infusions from Belgium, France, and Luxembourg. The bank availed itself of other Fed lending programs, too. Its total borrowings from the U.S. Central Bank's commercial paper funding facility ranked third among users of the emergency program created to support the market for short-term debt that was issued by banks and corporations. Dexia used the program 42 times for a total of $53.5 billion, according to the data the Fed released in December. Dexia also tapped the term auction facility, the lending mechanism the Fed established in December of 2007 to augment the discount window. Dexia received 24 TAF loans totaling $105.2 billion, the largest of which was $16.7 billion on January 7, 2008, the Fed data show. The lender used TAF about twice a month from December 2007 to December 2008, then once in August 2009 and once more in November of 2009. The interest rates it paid ranged from 4.65% in December of 2007 to 0.25% for the two loans in 2009. The Fed loans have been repaid, said Ulrika Pomey, a Brussels-based Dexia spokeswoman. The bank used the Fed's emergency lending facilities to finance U.S. assets only, Pomey said in an email statement. Quote, "We have always been very transparent in our communications about the wear and tear on us in the market during the crisis," Pomey said. In 2008, Dexia was hit with buyback provisions in municipal bonds, Pomey said. The bank was one of the biggest backstops of the bonds, providing letters of credit or so-called standby purchase agreements, guarantees to buy the bonds if investors wanted out. Dexia's so-called credit enhancement made it possible for money market funds to buy the bonds. Dexia provided $14.7 billion in standby agreements and letters of credit in North and South America, excluding Mexico, in the first half of 2008, a six-fold increase over the same period a year earlier, the bank said in its first half 2008 report. The growth was the direct result of a dwindling number of market participants able to offer such financial products, combined with the urgent needs of issuers to restructure their debt, Dexia said. Over most of the last decade, thousands of cities, counties, hospitals, and universities issued long-term floating-rate bonds and paired them with interest rate swaps to try to protect against higher borrowing costs. The strategy, which relied on banks such as Dexia to guarantee a market for the variable rate notes, collapsed when investment firms and bond insurers lost their top credit ratings. Interest rate swaps are derivatives or contracts whose values are derived from assets, including stocks, bonds, currencies, and commodities, or from events such as changes in interest rates or the weather. Swaps are private contracts, and the market for them isn't regulated. Redemptions sapped Dexia so much that the bank was, quote, 2 days from bankruptcy, unquote, Pomey said, citing the French Ministry for the Economy. Dexia's lifeline from U.S. taxpayers came as federal officials were investigating allegations that Dexia's subsidiaries colluded with others to defraud state and local governments. 2 former Dexia units were among more than a half-dozen financial firms that conspired to pay below-market interest rates to U.S. state and local governments on so-called guaranteed investment contracts, or GICs, according to documents filed in a U.S. Justice Department criminal antitrust case. Municipalities buy GICs with money raised by selling bonds, allowing them to earn a return until the funds are needed for schools, roads, and other public holdings. An employee of Financial Security Assurance Holdings Limited, one of the Dexia subsidiaries, agreed to pay kickbacks ranging from $4,500 to $475,000 to a Los Angeles investment broker called CDR Financial Products Incorporated in exchange for rigging bids, according to people familiar with the case and public records. CDR employees fed information on competitors' bids to FSA, allowing the firms to win deals at a lower interest rate than it would have paid, according to a federal indictment, public records, and the people. Stephen Goldberg, a former FSA banker, was indicted in July on fraud and conspiracy charges. He has pleaded not guilty. FSA, which hasn't been indicted, is facing a lawsuit from the U.S. Securities and Exchange Commission. While Dexia sold the bond insurance unit of FSA, it remained exposed to legal risks because it kept another division of the company, its financial products segment, Dexia said in its third quarter report. Dexia has said its funding from the European Central Bank remained at 18 billion euros in February of 2011. Still, its borrowing with the Fed, quote, was a temporary situation and now they're trading just fine, unquote, said Nat Singer of Swap Financial Group LLC in South Orange, New Jersey. So basically, we were bailing them out to keep the resulting financial collapse from collapsing American municipalities and states and other institutions. Turns out that they were engaged in criminal wrongdoing, apparently at the very same time conspiring to defraud their clients. Interestingly enough, if there are a number of indications that yet another financial collapse may be upon us, and if in fact that produces something very similar to what we've seen, or something in any way similar to it, guess who may be left on the hook again? Okay? That doesn't sound like a whole lot of fun at all. This following story is a story from the Bloomberg News Service once again. It's by Aaron Kirschfeld and Serena Sato from January 28th of 2011. This quotes Josef Ackermann, the chairman of Deutsche Bank, or the chief executive officer of Deutsche Bank, saying that basically with the financial risks that are on the horizon, if the hedge funds go belly up, the public may have to bail out the hedge funds as well. Again, from Bloomberg from January 28th of 2011, Deutsche Bank AG Chief Executive Officer Josef Ackermann said unregulated financial companies such as hedge funds may pose a systemic risk to the economy if oversight isn't increased. Quote, you have an unregulated area which becomes, as a consequence of all the regulatory changes, more and more important, Ackermann 62 said in an interview at the World Economic Forum in Davos, Switzerland. You may one day wake up and realize that the systemic challenges are so big that you will have to bail out or at least help support the unregulated sector, unquote. Ackermann's warning echoes comments made by former U.S. Treasury Secretary Lawrence Summers, who said this week in Davos that regulators haven't paid enough attention to problems that could emerge in a, quote, large, less healthy Buccaneer sector. Hedge funds have dodged the brunt of new global banking regulation aimed at avoiding a repeat of the worst global financial crisis since the Great Depression. If you separate utility banks from casino banking, you will one day realize that casino banks are also counterparts to corporations, but also to other banks and asset management, and to governments, unquote. Ackermann said yesterday, again quoting, it would be somewhat naive to assume that if you have a strong regulated sector and leave the unregulated in the open, that you will never have systemic risk, unquote. In other words, what he's saying is that with the apparent risk that's unfolding, if something isn't done, we're going to have to bail out the hedge funds in order to avoid a total collapse. And that's going to be interesting as well. Yet another Bloomberg story, Bloomberg News story, this from Andrew Fry of February 11th of 2011. Warren Buffett has weighed right in, and I think he's Jimmy Buffett, singer Jimmy Buffett's either uncle or cousin. I'm not sure which. But in any event, Warren Buffett has weighed in, and here's what he has to say about the looming financial situation, shall we euphemize it. He's saying basically that already it's too late, that too big to fail is a reality, and that if it happens, well, we're just going to have to bail out these big institutions. Again, from Bloomberg News Service of February 11, 2011, Warren Buffett, the billionaire chairman of Berkshire Hathaway Incorporated, told the Financial Crisis Inquiry Commission that taxpayers will always be on the hook for collapses at the biggest U.S. companies. Quote, you will always have institutions that are too big to fail, and sometimes they will fail, Buffett 80 told the FDIC in a May 26th interview, according to a recording released by the panel yesterday. We still have them now, and we'll have them after your commission report, unquote. The Dodd-Frank Financial Reform Act, enacted in July, was touted by President Barack Obama as a means to ending bailouts and protecting taxpayers from firms that are too big to fail. Federal Reserve Chairman Ben S. Bernanke, who made more than $3 trillion of assistance available during the crisis, has said that the, quote, too big to fail issue can be eliminated only when investors believe the U.S. won't rescue firms. Investors were rescued in 2008 by Bernanke and then Treasury Secretary Henry Paulson, whose relief programs cushioned declines for stockholders and bailed out bondholders at firms such as American International Group. And so Warren Buffett saying basically it's too late to stop too big to fail. and failed, things just might. There is a vulgar military slang acronym, BOHICA, B-O-H-I-C-A. Basically, it stands for Bend Over, Here It Comes Again. And in the news and supplemental section on the SpitfireList.com website, I have a number of posts under the general heading of BOHICA, and I'm going to run through a few of these. This is an article from ABC News, March 2nd of 2010. Economists, another financial crisis on the way. Reading in part, even as many Americans still to recover from the country's worst economic downturn from the Great Depression, another crisis, one that will be even worse than the current one, is looming, according to a new report from a group of leading economists, financiers, and former federal regulators. Worse, is it? Terrific. A Wall Street Journal article, BOHICA, Part 2, Wall Street Journal article by Mark Gongloff, David Enrick, and Sarah Schaefer Munoz, European Bank Lenders Coalition of Unwilling. And what this is talking about is the dry up of short-term lending to a lot of European banks. That is serious, if not fatal, to financial institutions and could lead to the failure of European banks. And guess who's going to bail those out or lend them money? Basically, the article reads in part, lenders to the major European banks are growing increasingly cautious, demanding higher rates for shorter periods, adding further stress to an already fragile financial system. Worries about sovereign debt have caused banks and other investors to pair risk. At the same time, new restrictions on money market funds, which are big lenders to the banks, are forcing them to pull back on their lending. There's an awful lot of red ink on those European banks' books. Bloomberg.com article by Gaby Tasing. Banks' overnight deposits with ECB increased to record. Update. Again, relates to the dry up in funds for these particular banks with a lot of red ink on their books. Overnight deposits with the European Central Bank rose to a record yesterday as the sovereign debt crisis made banks wary of lending to each other. This, in certain respects, mirrors what was happening in the run-up to the collapse of 2007. 2008. And this is interesting, too. This is from Financial Times of February 18th of 2001. Junk bonds yields at record low by Alan Von Deen and Nicole Bullock. Interest rates on junk bonds or high-yielding debt have hit an all-time low of 6.8%, fueled by investor appetite for riskier assets amid growing evidence that a U.S. recovery is underway. And this, too, a drop in the yield by junk bonds, was very much characteristic of this is similar to what was going on in the run-up to the collapse of the financial industry in 2007, 2008. And basically that high risk is being sought because of relatively low interest rates elsewhere. So junk bond yields at another low. Is that signaling a meltdown? If so, we know who's coming to the rescue, don't we? Anyway, this concludes For the Record 741. Bail, bail, the gang's all here. Or update on the meltdown, part 7. Bail, bail, the gang's all here. This is being recorded on April 23rd of the year 2011. My name's Dave Emory. Thanks for listening.